Today, folks, just for you dividend lovers, I've got two dividend stocks we're uncovering, one of which yielding damn near 9%, the second one with only a 1.8% yield, but is growing at quarter over quarter and has increased at 20% year over year. This is absolutely insanely mind-blowing considering these both fall within the financial sector of Canada, and a lot of people don't see these stocks because they will not show up in equal weight bank ETFs or even financial ETFs for the most part. And we're talking about Mcan Mortgage Group with an 8.93% yield, a $666 million market cap, and EQB Inc., which is a small bank here in Canada that only yields 1.86%, but don't let that deter you away. I promise the growth is crazy with a $3.7 billion market cap. It comes to nowhere near close to the crazy size of our monopolistic banks. Now, both of these fall into the same sector of residential and commercial real estate lending. Both of these are crushing it year over year. EQ Bank's up to almost 13%. Mcan's up 9.69%. I follow Mcan a lot more because my parents have a small piece of this within their retirement portfolio, and EQB kind of came up in conversation on my live stream on Sunday. So if you guys enjoy talking about stocks, join me Sunday, 9 p.m. Eastern, every Sunday. That's where these conversations come about, where one of you recommended this. And we're going to look into both of these because Mcan has been around since the 90s, has been crushing it, has had less volatility through recessionary periods like the '08 financial crisis than the S&P 500 went through. And EQ Bank has had a lot more volatility, but also experienced a hell of a lot more growth and has also been around basically since the early 2000s. Now, I'm shocked at the performance of these banks in the backdrop of major mega cap banks here in Canada that have been struggling and have had to put a lot of loan loss provisions aside. You know, there's a lot of worries about residential and commercial real estate, yet somehow these companies make it look like there's no problem at all and have excelled in this weird market environment, which again blows your friggin' mind. Like I can't get over it, to be honest. It's so peculiar. And we're going to take a look because Mcan, first and foremost, has basically 43% of their entire portfolio in securitized insured residential mortgages, which are pretty safe for the most part, right? Then you got residential mortgages at 28% and construction loans at 20%, and then commercial loans at around 1%. Now, construction loans and residential are where my concerns lie, and we're going to see that in some of the data, especially with EQB Bank there. But if you look at the loan, portfolio quality, it's quite impressive overall. I mean, the return on, just assets here, or the return on equity, has been astounding at 15%. And this is kind of how they're yielding this dividend of 9%, because so long as they can retain these kind of return on equity, they pay out almost all of their returns in dividends, which we'll see in a moment here, because there's been a little bit more volatility to the dividends than you might see on something like Seeking Alpha. And I love that it actually shows you the annual dividend yields here. And it's quite incredible. They paid a few special dividends in 2021 and 2022, and they're continuing in this higher interest rate environment to pay out record dividends in their, compared to the historical past, which is nuts. So they're growing the dividend in the backdrop of this tough market environment, and they have a reinvestment dividend plan. We'll even get a 2% discount if you just reinvest the dividends, which some companies do. I think Bank of Nova Scotia, I don't know if they're still offering the 2% discount. Some of these banks do offer that on a drip enrollment. If we take a look at the impairments, which is where my real interest comes into play, we'll just skim through the balance sheet along the way, because first and foremost, I'm paying close attention to net income, because there is quite a bit of volatility quarter over quarter. From Q1 to Q2, we've seen about a 15% drop from 23 million to about 19 million. Again, the net income, but year over year, it's still up 10%, which is quite impressive. But I'm so curious to what causes the volatility. It's something that we're always going to be paying close attention to here. But when you scroll down, and again, what I find most intriguing here is the credit quality with impaired loan or impaired mortgage ratio, sitting about 3.5%. And again, from Q1, it was at 3.42%. So it is increasing as compared to 3.26%, this time, basically of 2023, or December 31st of 2023. So there's this incline, right, of, credit quality, which again is something that we're seeing with all the banks. It's still pretty insignificant, I think, in the totality of it. But I really want to listen to an earnings call and get a real scope of how management feels here, because again, this is a company that has been diluting shares. So I'm really impressed with the performance of the stock to be in a position like this, where you can pay such a high yield, have stock performance, still be issuing shares, and sitting in one of the worst financial environments that we've experienced in a long time, and what that risk truly means. Because again, I am not a genius in the sense of financial institutions or the market environment we're currently experiencing. So that's Mcan. I was just kind of scrolling through their investor presentation presentation, and this is just some of the stuff that I found that I just find, most intriguing. I got 5.1 billion total assets, 614 million in the market cap, about 20 million net income there. Again, 24% from Q2 of 2023. It's like I said, the growth here is quite impressive. However, let's take a look at EQ Bank. I was just kind of diving around on their financials. If you've never seen this bank, again, I've never seen it. It came up in conversation. I was completely unaware outside of maybe like Tangerine that there were kind of a multitude of smaller banks that are upcoming in the Canadian environment, in the Canadian marketplace. And this one, again, no exception. It kind of reminds me of like National Bank, but the growth since 2014 has been more in line with tech-oriented companies, which is quite impressive in my opinion, to get this kind of excelled performance in the backdrop of the TSX that doesn't do nearly as much. It's quite impressive. So this is a company with about 317 million in revenue that is growing 20% year over year, which is insane. Provisions, pre-provisions, pre-tax income, you're talking about 174 million adjusted, net income 111 million, return on equity very similar to Mcan at about 15.9%, and the dividends are up 22% year over year. This company's dividend growth is stupid. I mean, look at this. They increase it every single quarter. I mean, from 2022 alone, from 29 cents to 45 cents. I mean, they're on path to double the dividend, in less than 5 years here, which is in less like a few years. It's kind of crazy. And I don't know if it's more related to the interest rate environment, because you can see the growth wasn't nearly as substantial as it was as of late, right? So I'm very curious to what's driving a lot of this. When we take a look at those gross impaired loans, again, where my fixation is, we can see that they've actually seen a leveling off, which is what we need to see across all the banks. If we can see a full leveling off, I think we could start getting a sense that the sign of the bottom of loan loss provisions is going to come into play, and that's when we'll start getting a recovery in Bank of Nova Scotia and TD, all these banks. But when looking at this, the thing that fears me the most is basically they've seen a huge drop in commercial equipment financing, which I don't know why or what the deal is with that, because personal and consumer lending has still increased dramatically. I mean, from Q1 of 2023 to Q2 of 2024, from 60 basis points to 218. It's crazy, but they were saying that it's improved by 22%, and it has nothing to do with this really shows that the personal, consumer lending environment is tough. We've seen this with the credit card data in the US. I mean, credit card data is not at any kind of crazy historical levels, but it's back to levels of defaults we haven't seen, or impairments that we haven't seen since 2011, like over a decade ago. So these are super concerning data points still, in my opinion, and there are things that we need to start seeing leveling off before I'd be super comfortable, which is why I'd still rather stick to the most point of owning banks and things through ETFs to kind of diversify some of that risk. Even though the banks in Canada, the lending environment in Canada has excelled and survived every single recessionary environment far beyond what the US has done. But again, if you take a look here, the growth is still quite exceptional. When you take a look at, we'll scroll down here. If you take a look at total revenue from 502 million to 615 million, is exceptional, right? I mean, this growth and net income is very healthy, from 145 to 210 for the 6-month ending. It's just nutty. I'm blown away by this growth, and it's something that you have to take into consideration, that if interest rates start coming down, are they going to be able to achieve the same interest income, right? Because if you look at the interest income, it has gone up dramatically. And you've got to ask yourself, in this market environment, typically banks do better in higher interest rate environments, but the loan loss is what's offsetting the interest income for most of these banks, whereas this bank clearly isn't dealing with the same kind of loan loss provisions, which is quite fascinating to me, and something that we're going to have to watch closely just to see where we end up. But again, you take a look at the financial results, and you can't really argue these, right? Return on equity hasn't been that crazy overall, but adjusted, I think this quarter has been a lot better for the most part. If I'm reading this correctly, net interest margin, there's a lot going on here, right? Like total revenue is up. Again, you look at year over year, 20%. It's crazy. So a lot of these data points, it just proves that there's more nimbleness, I guess, in the smaller cap realm of things versus the large, cap banks, because you can see the net interest margin here has been increasing. Net interest income has just been going up. So I'm really curious to see how these banks operate, and even with Mcan, how they operate through the raising and lowering of interest rates, because clearly the raising of interest rates has done nothing but benefit them. And again, they have long-term track records. This isn't something that just came up. Like, these companies have been paying these yields and sustaining them for quite some time. So I'd love to know what you think about these. Are the things that you own, do they interest you? Tell me your thoughts in that comment section below.